Hey, good afternoon, everybody. Don Winter here with my associates Rich and Larry. Hope everybody's been having a great summer and excited to be here. It feels like it's been a little while. We've had some big events in the last couple months, but it's been a little while since we've gotten together in this kind of webinar format. So thanks for jumping on with us. We're excited to kind of share kind of what we've been up to this summer. Hope you've been up to some fun things. We'll tell you what we've been doing here at Dlp a bit, some of the most recent updates, and we'll share a little bit about what's ahead at Dlp, including the launch of 2 new funds next month. Pretty exciting. We haven't launched a new fund in a couple years. We're launching 2 at the same time, so we're pretty excited about that, and tell you a little about what's happening in this amazing and crazy real estate market right now as well. So as always, type your chat questions in. We'll answer all questions here at the end. So type them in and look forward to answering those throughout this evening. So thank you, Larry, Rich. Anything to add there before we get rolling?
No, just welcome everybody. Appreciate everyone hopping on with us. We've got a lot of exciting things going on, and we're looking forward to taking those questions and answers at the end. Thanks.
Awesome. All right, so I'm going to dig in here. Here's our, I like to call my Barry disclaimer, Barry, our Chief Legal Officer, kind of legal disclaimer here. All right, so for those of you who are new, and we do have some, I know, with us for the first time, welcome. Thanks for jumping on here with us. This gives you a little quick overview of Dlp, our various business lines that work together to execute on our business model, which I'm actually going to show you that visually in a moment. The company that offers the investment vehicles that you're going to hear a little bit about tonight is at the top, Dlp Capital Partners. And investors choosing to invest and entrusting their capital with us is the engine here at Dlp that allows us to do all the things we do and make the impact that we're making. And we'll highlight a little bit on here as I continue. This is the, actually skipped a slide here. This is our senior leadership team. You're going to see a couple new faces here on this senior leadership team, including Jeff Bray, our new and first Chief Operating Officer, and Chris Osmond, Managing Director, who I'm going to introduce a little bit about Chris's background here in a minute. He's on day 3 today here at Dlp, but incredibly excited to have him on the team. And this is our awesome support team who provides you with hopefully always great customer service and support, and make sure we get your distributions out on time, your accounts up to date, K1s out, etc. New team member there in Maryland who just joined us here this past week as well, and excited to have her on the team. But great team supporting everything we are doing and driving the results each day for all of you. Quick bit about myself for those of you who are new to us. I started Dlp 15 years ago now. I've had the pleasure of doing over $5 billion in real estate transactions as an owner, investor, and as a lender. And I wrote a book recently called Building an Elite Organization, which I'll touch on here very briefly in a moment. And I don't see it on the slide here actually, but I'm proud to say just a day or two ago, we were named the Inc. 5000 fastest growing company list for the 9th straight year, 4th fastest growing company of all companies that have made the list 5 or more times, and number 1 in real estate. So pretty exciting, and it's just a testament to the way we go about growing, that we've grown between 300 to 500% every 3 years now for 15 years. So something we're pretty proud of. Speaking of the growth that we're having, a big part of that is that we bring in incredible, talented, intelligent, driven individuals here at Dlp. Chris certainly checks those boxes. Chris has a wealth of knowledge and experience. You can see from the alphabet behind his name there. He's a CFA, he's a CFP. He's been most recently Chief Investment Officer for a $17 billion RIA firm called Prime Capital Investment Advisors, leading all of their investments, and is joining our team here at Dlp. He's going to have a number of key responsibilities and priorities, none of which are greater than the focus he's going to be putting on continuing to grow the the value and services and education and resources that we can provide to all of our investors. So super excited to have Chris on the team. Look forward to many of you getting the opportunity to chat with and get to know Chris in the days, weeks, and months ahead. He just moved his family here from Kansas City to St. Augustine just this past week, and incredibly happy to have him on our team. We had another new team member just start this week, Simon, who just left my office right before I jumped into this meeting. I'm actually talking to you right now from all of us are from our new headquarters in St. Augustine, Florida. And Simon's on day 2. He's our president of our memberships, software, and events. Simon was actually at our last Asheville event a few weeks ago. They're kind of going through the final steps of his evaluation and interview process, and brings a tremendous background in actually running similar membership businesses to what we do with our prosperity membership and our elite membership, and brings a wealth of knowledge and leadership and experience to our team. And incredibly excited to have him aboard, and he'll be primary focus is around bringing value to our clients, to our members. So really excited for many of you to meet Simon here as well in the weeks ahead. So this is a slide here that helps a lot of people when they see that slide I showed a few minutes ago of all the DLP companies, and it can be a little bit confusing and overwhelming to understand what are all the things that DLP does. And in very simple terms, this little we call flywheel on the screen here really describes DLP's business model. And this is what we do, and this is what the 450 people at DLP work together to do each day. And for us, our flywheel of what are the components of our business model that allows us to continue to grow and serve more people and create prosperity is this simple as what's on the screen. So the first thing is we bring capital into our investment funds. Predominantly, our investors are faith-centered wealth creators as we think about them. They're largely first-generation, value-driven individuals. And we're focused on not only helping them earn great returns and build wealth, but also focused on helping build legacies and families. And that's what our prosperity membership is all about. Then we take that capital that you entrust to us in the existing funds we run, as well as the new funds. I'm going to give you a little teaser on here in a few minutes. And we invest that capital into housing. We do so as a lender, and we do so as a partner to other operators, and we do so directly as an operator, as a sponsor, as a developer. And then we go and we scale companies. We scale the DLP companies as well as the companies that we lend to and partner with through elite execution, which is what the book I wrote is on, our elite execution system. And if we do that well, we create prosperity, not just for you, our investors, which is certainly critical, but also for the operators and borrowers of ours, the residents, the 30,000 residents that live in our properties, and the 450 team members that work here at DLP and their families. And if we do that well, we create that prosperity. More capital comes into our funds. We're able to invest more money in housing, creating affordable workforce housing, scale more companies and create jobs, and create more prosperity. It's a very simple business model at the end of the day that all of us are working towards, and all focused around these 10 core values that you see on the bottom of the screen. At the center, you see there stewardship, which is very much central to what we do here at DLP. We've been focusing more and more of our energy, effort, and focus and filtering it around impact investing. We want every investment we make here at DLP to be making a positive impact. In fact, not only are we launching these 2 new funds, we're actually finalizing a process right now of formalizing all of our funds being impact funds, literally having that in the mandate of the funds that we're making a impact, a measurable positive impact, while also generating, of course, great returns to our investors. We've set 4 areas of focus here at DLP that we are focused on continuing to make a bigger and bigger impact on. First is the most obvious one, which is the affordability crisis, the crisis of workforce housing affordability. The fact is over half of Americans are burdened by too high of a cost of housing, spending more than 30% of their income on just their housing costs, their gross income just on housing. And that percentage continues to grow, and the cost of housing continues to climb in almost every market around the country. The second crisis we're really focused on is the jobs crisis, and the fact that many of the U.S. jobs many of the jobs here in the U.S. today won't be here in a few years, or let alone over the next decade or two, as they're being replaced through this amazing, technology and innovation that's happening in so many industries. That's not all doom and gloom. New jobs can be created and will be created, but they will be created largely by small businesses. Small businesses are who are going to create new types of jobs and be able to help people retool in this ever-changing economy. And we want to be a part of that solution, helping small businesses scale and in turn create jobs that provide happiness, which is the fourth crisis. I'm skipping over one right there, which most people right now, we have the highest level of unhappiness in America in history. And at the end of the day, most people are searching for purpose and connection, and more are having a hard time finding that. And we want to be a part of that solution and working on that in a number of different ways. And then last, but certainly not least is the legacy crisis. And most of you listening to this right now are first generation wealth creators. And statistically, the odds are very high that by your second or third generation, all the wealth that you've created in your lifetime will be lost. We've all heard the saying, or at least most of us probably have, the shirt sleeves to shirt sleeves crisis. And we don't believe it has to be that way, that can be changed. And your family, your wealth can not only be able to create generational wealth, but grow generational wealth and be a part of be able to continue to grow that wealth, not just have it last for generations, but continue to be able to grow it through a different mindset of what you're trying to accomplish with your wealth, through education of within your family, through appropriate planning. You don't have to fall into this shirt sleeves to shirt sleeves in 2 or 3 generations crisis. So those are the areas we're focused on. One of the big things we've been doing to help us make an impact across many of those crises is helping build elite organizations, which is what the book I wrote. I wrote the book last year. It was published this April. Proud to say, thankful to many of you and the clients and investors who support us. We've been top 5 on Wall Street Journal, USA Today, #1 on Amazon. And what's important about that is it's allowing us to get our operating system, our blueprint to scaling high growth, high profit businesses out to more companies that are going to help inspire them to grow their companies and create more jobs. And most of the companies we're hands-on helping do this are also focused on creating housing that's affordable for the local workforce. So it's been really incredible past 5 or 6 months since this book's come out, and the growth and the scale of impact we're able to have. And it's really a starting or launching point in what we have coming ahead. I'm going to play a quick video or so, or actually 2 here, to kind of show some of the impact in action that we've been making here this summer. This first video is from one of our borrowers, one of our best borrowers, Key City Capital, over the past couple of years. I'm going to go ahead and play this little video.
We've been working extensively with Dlp over the last 2 years. We've got a strong relationship now. I'm Ty Laster, CEO of Key City Capital, building an organization that satisfies the demand that we have now for strong jobs. We're adding jobs significantly every month. We've seen exponential growth every year. We more than tripled in size as far as employees last year. We're looking to do that again this year. And I think this goes back to the culture that we're creating. If it wasn't for our culture and a focus on building that culture first, we wouldn't be able to sustain that growth. One of them specifically is our RE case. Having clear expectations of a candidate when they come on, before they come on, and already having those conversations with that candidate and bring them along to rise up to levels probably higher than they would have otherwise expected themselves. Adding in the L10 meetings and having a structure around meetings. Oftentimes you find out in an organization that there's a lack of communication, or there's meetings where communication is had, but there's no clear transactional management coming out of that meeting. Having a structured format so that we can go in and say, here's the problems that we're having right now, here's how we're going to solve them, and here's who's responsible for what piece of that.
So that's an example. Some of those things might not have resonated exactly what he was talking about, some of the terminology, but you can see the level of focus that we're having with these operators. They're not just focused on raising capital and buying real estate. They're focused on building great companies, improving communication, hiring more people. And that's a big part of why not only has our lending business and our ability to deploy capital grown so much so far this year. We're up almost 300% year to date, is how we've also been able to mitigate risk by really helping these operators put discipline into their organizations while creating a lot of jobs and growing fast. So here's another quick one. This is one of our property managers at one of our communities we've owned for over 3 years. We call it Prosper Orange Beach in Orange Beach, Alabama.
Prosper Orange Beach is a great example of DLP's impact in action. We've truly become a part of this community, and in turn, the community has responded.
We enjoy the staff. You can even just go sometimes into the office and talk with them. They're just like a friend. You can approach them and they help you. And they help you in things, sometimes it's above and beyond their own duties.
Everybody's just so friendly, so everybody's in a good mood, positive. The energy's really good down here. Nothing bad to say about this place.
We do corporate leases, so it really helps people, that don't want to have to get a ding on their credit or can't afford a mortgage and a place to rent. So their corporation does it for them. We are a big part of everyone's lives. And we just try to make it one-on-one. We know their names, we know their pets' names, and we know what's going on in their lives.
Hurricane Sally really hit us rough. We had to replace all of the roofs.
We had, I think, 8 apartments that were flooded and affected.
The next day, we were literally out with the residents picking up limbs, and we went and got water because we were without power for a long time. We cleaned up everything in-house with our team and the residents, and it really showcased just the true spirit of community.
I was up until 2:30 in the morning, keeping the storm drains clear as best I could until about 3 o'clock in the morning. It just got too bad humanly to go out. So a lot of residents see me out there doing it. So you see the flashlight floating around, checking all the drains.
To see them inside the swimming pool, trying to clean it out, to taking people where they needed to go to get food for the day. You can't say enough about everything they did then. They're just awesome.
Despite having many challenges through COVID, this has been one of our best performing communities. We've gone above and beyond helping connect our residents, to help them through tough times and job loss. And in turn, we've been rewarded, and our investors have been rewarded as we've generated over 20% returns over our 3-year investment net to investors. All at the same time, while being able to invest in our great team. We've had team members develop and grow and really become a part of the DLP family.
I'm so glad that I landed here at Prosper Orange Beach, because I have looked around and realized that this particular complex really is and offers a lot. So I'm happy to be living on site, and I'm happy to be living in this area.
We went through COVID, we went through Hurricane Sally, so we've had a lot of obstacles, but we've really pulled ourselves together as a team and just tried to help our community and tried to help our residents as best we could.
And it's kind of one of the places where everybody knows your name. You're always glad you came, and that's what I think of when I come to Orange Beach. And I like the way that it feels when you come to the property.
It's just a great place. It's a happy place. I love DLP. It's a big goal of theirs is just, to help your community. And so we don't want to just be an apartment to live in. We want to affect your lives.
So that's that doesn't get you motivated, or I don't know what does, right? I mean, just amazing people. This community is owned in the Dlp Housing Fund, and it's part of a portfolio of 4 communities very similar to this one that we've owned here for a while. But phenomenal team, as you can tell, and this is where your money goes. I mean, this is what what we're able to do and the kind of impact we make each and every day, especially through our incredible frontline team members. So thank you to all of you investors that have allowed us to do this and continue to scale in our ability to make an impact and grow and provide great housing community to more and more residents. So it's pretty impactful when you get to see and experience what they do every day. All right. So speaking of that, we've been continuing to buy more great communities like Orange Beach. I'll show you a couple of our last acquisitions. So we acquired this community here. It was our most recent closing. We call it Dlp Dream Oxford. It's in Oxford, Mississippi. It's 234 apartments built in 2009. When we bought it, it was all student housing. We are now renting both to students and non-students. Really nice amenities, nice community, great location, and it's already been performing much greater than we would have expected. We bought this at a tremendous discount due to COVID and the effect it's had on some of the student housing communities and due to some of the school shutdowns last year. But it's been a phenomenal asset already, and really excited to be in this market, and it's been really cool. That was our first of two so far. We have another one under contract now, student housing properties that we've acquired with the same mindset that we're going to open up the community not only to rent to students, but to rent to non-students as well, opening up the marketplace. So this is a community in Kutztown, Pennsylvania, about a half hour north of where I grew up. It's actually the college my wife went to, Kutztown University, 184 units built in 2008. They're all these townhome style look and feel. We're at, I believe actually today at the start of the school year, we actually are at 100% occupancy. So incredible demand. And again, also picked up at a phenomenal price due to some of the stress that this student housing operator faced through COVID. So I'll show you a little bit about our performance this summer, this past quarter. In Q2, we raised over $87 million. And anybody looking at any of these slides here, any of the info I'm showing about what's happened this past quarter, and much of what I'm talking and showing about what's ahead, this is included in the Dlp Capital. Much new information I'm highlighting here, especially in a few moments, but a lot of this information is included in the summer edition of the Capital Report that should have most of you have received. And if not, shoot us a note. We'll send it over to you. And it's about a 40-page kind of overview that highlights a lot of this and much more as well. But this past quarter, we brought in over $87 million of new capital commitments from our investors, our greatest quarter ever. Thank you again. We funded over 241 loans for $165 million to investors. We generated just under 11% return in our lending fund, just over 11% return in our income and growth fund. We hit our preferred return in the housing fund, following up our reporting of our end of year 2020 financials a couple months back, where we hit almost 14% in 2020 in the housing fund. Hit great returns in our fixed fund, our equity fund too, which is just winding down now, where we've hit over 17% net to investors over the life of that fund over the past 5 years. And then, of course, we hit all of our fixed returns out to our fixed note holders in the Dlp Positive Note Fund. So a little bit about what's happening in the real estate market. Some of this will seem obvious to you if you're paying any attention to what's going on, because it's easy to see that the housing market has been pretty crazy. Price growth has been tremendous. We're at 16.6% increase in pricing over the past year. That's tremendous. And we continue to see just a lack of supply. We have a 42% decline in active listings on the market. Over 60% of homes that go on the market nationally are selling in under 2 weeks, or at least receive offers in under 2 weeks. So we're seeing tremendous demand and not enough supply. Good news in the category of supply is that construction activity is picking up. In June, we had a 6% increase over the month before, and nearly 30% increase year over year in new home starts, new construction starts, which is really critical in us being able to keep up with the growing demand. For renters, it's been tough. Rents continue to climb. throughout the country. Depending on where you're at in the country, rents have gone up 5 to 10% over the past year. In a lot of the lower rental markets, the $600, $700, $800, $900 rent markets around the country, where there's a tremendous need. The C properties in a lot of markets, rents have gone as high as 10 to 20% in much of the country. So there's just simply not enough rentals, enough apartments available in almost the entire country, certainly throughout the Sun Belt. So it's continuing. We're seeing incredible increase in average cost of rent. We're now up over 75% in rent over the past 10 years nationally. And look at some of these markets, like here in Jacksonville, right near here, has had 35% growth in one-bedroom rental rates in the past year, 35% in a year. Just incredible growth due to a lack of supply. So what we see in terms of what's ahead, the reality is that things are slowing down just slightly in terms of the price growth with more construction coming to market. It's helping a little bit, but we're expecting to continue to see a really, really strong housing market, continue to see continued growth in values as we continue to fight low supply, supply that can't keep up with demand. Some great stats here on it, but it's just, we're going to continue to see growth in values and continue to see demand that exceeds supply. On the rental side, we're also expecting to see much of what we've seen so far this year. Continued lack of demand, continued growth in rents. Nationally, according to Apartment List, one of the big data aggregators, they say rents are up 9.4% in the first half of 2021 alone. The data is kind of a little bit all over the place, but it's certainly been tremendous increase in rents so far this year, which of course is a good thing across our portfolio and for us as investors, but not a good thing for the economy as a whole and the crisis of affordability. So in terms of how we see the market, in terms of us in this meeting, in terms of us as investors, not only are rents growing and which is a positive thing as an investor, we're continuing to see, because rents are so strong, because supply and demand is so in the favor of ownership, because supply so underserves the demand right now, more and more capital is out chasing this space. More and more investors want to put their money in this space, even though we're at all-time high valuations. So we're continuing to see cap rates being compressed, meaning values going up. Because of the fundamentals of supply and demand, we don't see this changing anytime soon. And with the downside protection that fundamentally the rents are going up to support the increase in values, that provides downside protection, which is why even in the perception or thought or fear of a recessionary environment coming, people feel this is such a great place to put their money. And simply put, we need more housing. We need more construction to be able to slow down the rent growth and property value growth. We need more housing. And that's a perfect lead-in into what DLP is working on. So our new funds, we're about to launch 2 new funds. We're going to do the full formal launch of these funds on September 30th. We'll be doing both live and virtual event. So we'll be doing it live, but streaming it virtually on September 30th. And we'll be formally rolling out our 2 new funds. But I'm going to give you a little sneak peek here of what we're about to launch in the end of September. So the first fund we're launching is called the Dlp Building Communities Fund, which is going to be our first ever fund focused on building new rental housing. So up until this point, all of our equity investments have been in existing rental communities. I have invested and owned a lot of new development and have been doing more and more of it, but we haven't had a fund that was focused on investing in new rental communities, building new communities, both single family and multifamily communities. We've set a target of developing 40,000 new homes over the next 10 years, which will provide housing to 100,000 people. Won't solve the problem, but it'll certainly make a dent in the need for workforce housing. This fund is going to have the highest return target of any DLP fund. It will have all the benefits of real estate ownership, be very tax efficient through depreciation. This will be I'd say the only DLP fund that cash flow is not the primary focus, because most of our investments will not be cash flowing as they are going through construction development. But it will make a tremendous impact on the workforce housing crisis, as well as a job crisis, because there's not many, if any, anything that stimulates the job market and creates jobs more than the construction of housing does. So this will be a fund if you want to be in a very tax advantageous place, be able to get the highest return of any DLP fund. This will be the fund for you. The second fund we're launching on September 30th is the Dlp Preferred Credit Fund. So this is a lending fund similar to the existing Dlp Lending Fund or Dlp Income and Growth Fund. But this fund is focused on providing what we call preferred credit, meaning all of our money in this fund will go into the deals, into the properties ahead of all the equity, meaning all the equity is subordinate to the fund's money, but the fund will not always be in a first position loan. Often it will not be. Often it'll be subordinate to a first position loan. To offset the risk of not always being and often not being in a first position debt position, we will only offer preferred credit to our highest quality borrowers. On average, the loan we make will have over $1 million of equity invested behind our loan, so a lot of skin in the game. And this fund we expect generate at least 1% higher returns than the Dlp Lending Fund. So by sitting in a second position, we're able to get a little bit higher rates, but only to the very best borrowers with significant equity behind us. So the reason you'd be interested in this fund is this will be our highest return of any of our lending funds. It will provide consistent monthly cash flow, and we will only be lending to our highest quality borrowers with a lot of equity behind the fund. So both of these funds are focused on making an impact and helping us scale and create housing. We welcome you to please download our podcast called Impact. You can go to Impact with Don. We're on finishing up season 1 in terms of the formal launch, which is all on the jobs crisis. And very soon we'll be launching this season 2 here shortly. So welcome and appreciate your support and getting this out to others. We want to not only get your support in the impact we're looking to make, but really our goal here is to help inspire and help others make an impact on the causes and crises that are important to you. So in addition to the 2 new funds, we still have, of course, our other funds, which the things that all of our funds have in common is they all pay out preferred returns before we even earn a management fee. They all offer consistency in returns. They all invest in workforce housing. They all offer, we believe, significantly above market returns. They all have Dlp as the manager and have Dlp as the largest investor. They all accept qualified accounts, IRAs, 401ks, etc. They all have audited financial statements. Of course, the 2 new funds won't have audited financial statements until after the end of this year. They're all evergreen, meaning none of these funds are close-ended or they'll have a closing date and shut down and wind down. They'll all continue to grow and operate for many years, if not decades ahead. And all funds require investors to be accredited. So our other funds are the Dlp Lending Fund. This is our longest standing fund. We're running for 7+ years, generated double-digit returns in every month for 7+ years. The Dlp Housing Fund is our fastest growing fund, in many ways our flagship fund, which is our fund that currently owns nearly 8,000 rental homes, providing housing to about 20,000 residents. Pays out a 6% preferred return monthly. That's paid again before our management fee with a 12% return target. We generated a hair under 14% last year net to investors. And then we have the Dlp Positive Note Fund, which is a way that you can invest and get a fixed return. You lock into a return between 3 and 7.5% based on how long you choose to invest and how much you choose to invest. You can commit for 1 year, 3 years, or 5 years, and you can choose to take distributions monthly or let it compound and grow. Your choice, and you can change throughout the course of the investment as well. So due to time, I'm going to skip over this great video from some of our guests in Asheville, but we'll send it out in the follow-up emails as well. And I want to have time for questions here. So we have 2 upcoming events. We have a 1.5 day event here at our headquarters where I, Larry, and Rich are right now, where we'll be doing workshop events during the day. And then in the evening, we'll be launching on September 30th our new funds and be doing a big dinner event, which we will stream virtually for those who can't be with us live. So love for you to come join us here. We're going to have a great group of investors, of our close families who really want to make an impact here with us. So you can go there to dlpcapitalpartners.com/SEPT, and we'll put that link into the chat box too. And then we have our next big event, like we just did in Asheville in July. That'll be November 11th to the 14th at the beautiful Sawgrass Marriott Golf Resort in Ponte Vedra Beach, Florida, which is just about 20 minutes north of St. Augustine. This will be an incredible event. We have a tremendous number of world-class speakers that we'll have workshops focused around building wealth and your family and legacy. A lot of opportunity to get to know and build relationships with other incredible individuals and families. Really just an outstanding experience for sure. So for those who are in our Asheville event, we'll be bringing back some of the best speakers and entertainers. I'm going to keep quiet yet until I have it locked up from the last event. But we got a bunch of additional incredible speakers joining us, and we'll continue to elevate and take it to the next level. So really excited for that upcoming event, and would love for you guys to join us. We will truly, this is no sales pitch, we will oversubscribe the amount of space we have. We're starting now to run up against these problems where the event centers can't hold enough people for us. And so please get your RSVPs in as we get, not yet, but with the next few weeks, we will run out of space for that November event. So please get RSVP, come join us. It'll be a blast. And it's not a bad place to be in November, to be in Ponte Vedra, where it'll be 70s and beautiful, incredible golfing, lots of fun. So hope to see you at one of these upcoming events, if not both of them. So with that said, we're going to open it up here to questions. On the screen, you can see a lot of my great colleagues here who you probably are working with already, at least one of these individuals: Larry, Mike, Rich, Bob, and Brett. They'd love to chat with you one-on-one, talk to you more about what we can do, what we can offer, the upcoming funds, etc. So with that said, Rich, Larry, let's start taking questions.
All right. Thank you, Don. And I'd be remiss if I didn't point out that beautiful picture of the Island Green at the stadium course in TT Sawgrass for November. So that was a great time last year, and it's going to be awesome again this November. So let's go ahead and kick it off. The first, and again, just those of you out there that are on YouTube, if you can type your questions in the chat box, keep them coming. We have a few in here now, but would love to continue answering any questions on our existing funds, on our strategy, on the new funds. And we have a few of those as well. So starting it off, a question here from Amar. He would like to understand why the funds in the lending fund have decreased over the past few years, and how do you see that impacting the ability to pay EDC in the future?
Thanks, Amar. Yeah, great question. So these past, I think 3 months now, we've been about 10.6% net returns to investors. And to Amar's point, those are lower returns than we've historically hit, still above the target of 10% that we've had here for a long time. And we all know, nobody here is surprised when I say we are in an incredibly low interest rate environment, right? Is anybody surprised when I say that? Is anybody thinking, I had no idea, right? We all know that we've been in a no interest rate environment for years, right? Yet we're still generating 10% plus returns on a lending fund, lending first position loans at an average of 55% loan to value. We've done that while, since COVID, only having one borrower go into default in now 20 plus months. So we're lending to high quality borrowers in a no interest rate environment, and we're still hitting 10% plus returns while growing the fund and deploying more capital. We're doing all that while we're very thankful and are blessed that we've had such a growth in the size of the fund and so much capital coming into the fund that it's caused us, both because we want to deploy all of our investors' money, and also when we've gone through volatility like COVID, want to minimize risk. We've had almost no leverage from a practical standpoint. We've had 5 to 15% leverage over the last couple of years, meaning almost all the money in the fund is equity. So we haven't had the benefit of using leverage to increase returns, but it also means lower risk with very little to no leverage. So all those reasons combined that we've decided we want to make sure we continue to lend to the very best borrowers, continue to do so at low LTVs and LTCs, meaning a lot of equity invested, and be able to continue to grow. And to do that, we have to be competitive in terms of our rates. We're certainly not the cheapest lender out there ever, and we try to overwhelm our operators and borrowers with value through helping them scale their business through the events that we do that we just talked about, and really taking a hands-on effort helping them grow. But that's the direction we're moving in, and we're very confident that we'll continue to generate great returns, hit monthly distributions. But you're going to continue to see returns more like where they are today than certainly where they were 2-3 years ago with where we are in the current state of the economy and market.
Excellent. Thank you, Don. Well said. So again, I have a question in here from Harant, and having spoken to Harant many a times, I know that he's had this view for a while. So he thinks that once unemployment and the extra bonuses stop, that there's going to be huge repercussions in the market and housing and everything else. So he would like if you could elaborate on what impact that's going to have on rental payments, evictions, and on the properties that we manage.
Yeah, great question. And so all the programs that have been placed here in the CARES Act since COVID have been certainly in the business of housing. There's been as many positives as negatives, and it's been there's been a lot of really good things that have helped us and things that have really hurt us. So the things that have really helped us, as Harant said there, is that there's been this incredible unemployment benefits that have helped a lot of people who've been unemployed, especially in the depths of COVID, to be able to make enough money to make ends meet. And we could have another philosophical conversation we don't have today on if those programs have completely always been a benefit or a hindrance, especially with many companies today struggling to get people back to work because of them. But that's maybe another conversation for another day. But certainly as a landlord, it's been a helpful in many cases. But the other side that's made things very challenging, that you probably all have heard about, is the forbearances on evictions. So never in history has the government come in and said, somebody doesn't pay you, you can't do anything about it, right? And so that's been a very interesting, unique challenge we've had to deal with. So they, in some ways, you could say have balanced out in terms of the positives and negatives that it's brought. The good news, though, is those forbearances on evictions will fully end. It keeps being extended, but it will end in the very near future. And even when the unemployment incentives run out, the reality is the type of apartments we own, which our average rent today across our portfolio is about $878 a month. In $878 apartments, even if all those people who are collecting unemployment benefits, it's helping them make ends meet, when that stops, if every single one of those people had to move out of our apartments, we'd be able to have them move out if we were restricted from evictions. We have almost always essentially a waiting list of people wanting to move in, who do have jobs and aren't counting on those unemployment benefits. So the demand for workforce affordable housing, especially the $800,000-$900,000 a month apartments that we own, so outpaces supply that even if 5 or 10% of the market no longer can pay the rent, the demand is still substantially higher than supply. And keep in mind, those who live in $1,600, $1,800, $2,000 a month apartments, when those incentives run out, they're going to need to live in somewhere more affordable, which will actually increase demand on the type of housing we own in most cases.
Excellent. And I think you answered the question from Duncan in the process, but I'll ask it anyway, because again, he's looking not just what the delinquencies are now, but what's your outlook for the overall rental market and delinquencies in the rental market?
Yeah, so our delinquencies right now, end of last month, I believe, and I don't have the data in front of me, but I believe we were at 5.4% is where we ended last month across our portfolio. That is higher than where we would like to be, but in that number would be closer to 3% if it weren't for just a few communities that are struggling harder with unemployment and also struggling. Some states have done a really good job of getting out some of the rental assistance programs and so forth. Some have really struggled, such as Arkansas, where we have our highest delinquency. But once these eviction moratoriums end, much of that will be resolved, and we expect our delinquency to go down closer to 2%, where we've been pre-COVID. So again, because demand is so high, the reality is if right now screening and finding tenants with good jobs who can easily afford to pay rent is not a challenge in the vast majority of our portfolio. And I'm not expecting it to be a challenge because, again, demand is so greater than supply. So, but in normal environment, other than this, since COVID world, if somebody doesn't pay rent, as much as we do a lot of things. I don't want to sound heartless here. We do a lot of things. Our on-site team has spent thousands and thousands and thousands of hours over the last number of months alone, helping find our renters who are struggling with payment, rental assistance programs, doing the applications for them. We do all kinds of ways that we come in and help our residents through our foundation, otherwise, who are in genuine hardship. But with that said, when we don't have these eviction moratoriums, somebody doesn't pay their rent, we move them out generally in 35 to 40 days, and there's incredible demand to move somebody else in. So feel very confident in our ability to continue to occupy our apartments at a very high level and continue to collect the vast majority of rent that's due to us.
Awesome. Great answer, Don. And actually, that's a great segue into another great question that Paul had. So, perhaps for our portfolio, as well as maybe at a more macro level, what's driving the demand for homes and rentals? He comments that the population isn't growing that fast. So what can you attribute that demand to?
Well, it's a great question. So first, population is growing pretty fast in the markets we're in. So keep in mind, most of our housing is in the Sun Belt region. So population growth in many of the markets we're in is pretty significant. So certainly some of the Rust Belt type states and markets are not dealing with our population growth, and in many cases dealing with population decline. But many markets we're in, it's pretty tremendous population growth. So that's first thing I'd say. The other drivers are that much of the workforce housing space is where we again focus on, and much of that housing is being removed from the housing stocks. It's not only that there is limited new construction coming to create new workforce housing. There's very little of that in most markets. In addition, many of the apartments or homes that are affordable for the residents in the local workforce are being removed from affordability. And they're being removed from affordability through a number of things. Either A, investors similar to DLP, but with a different business model, are coming in, buying an apartment community that have rents at $900 a month and putting $40,000 into each unit, into each apartment, and raising the rents to $1,500. That takes them out of the affordability pool for most of our residents. Or in more urban settings, we're seeing a lot of affordable housing being demolished and new high-rises, both housing and otherwise, are being built. So an estimate of 500,000 units annually that are currently deemed affordable are being removed from the affordability pool on an annual basis. So when you have 500,000 units going out, and only a total of about 1.5 million total new housing units being built a year between for sale and for rent, multifamily and single family, that's a problem. And then with the growing cost of home ownership and housing prices soaring, that's pushing more people to become renters or stay renters as well. So that's only increasing the demand. But, generally we have a housing stock that's aging here in America. And as when you have an average age of a house in America continues to be older and older, more and more homes are becoming unlivable, coming out of the housing stock due to just age and lack of being taken care of. So there's a number of components that are creating this shortfall, especially again in the space of the 800,000, even $1,200, $1,300 a month apartments in most of the country.
Awesome. Thanks, Don. I'd like to take a slight step sideways regarding creating jobs, and a comment that Art made, some great insights regarding not agreeing that small companies are creating jobs. He mentioned that the Wall Street Journal yesterday was speaking about how cheap capital, technology, larger companies are having a significant advantage. So it seems that fewer new companies are being created than 10 or 20 years ago. So, what is your take on, high-paying jobs in large companies potentially taking away the incentive to start new businesses, and how does DLP plan to help solve that crisis?
Yeah, it was a great question, and there's a lot to that for sure. So I definitely, we all see right now, partly due to, we touched on briefly before, the unemployment incentives that have certainly kept a lot of the unskilled or low skilled workers out of the marketplace. But overall, with how strong the economy is right now in so many sectors, and the lack of workers, there's no doubt that, which is a good thing, we've needed it to happen. There's no doubt that especially those highly skilled are in demand, and compensation is going up, which is great, because I don't know the stats today, but last I looked at them, incomes have only gone up 6 to 8% over the past decade nationally, versus housing has gone up 75%, right? So we need rising wages, and that's a good thing. And certainly if highly skilled and driven people who would often be entrepreneurs and start businesses are being provided with more economic benefit and incentives to stay in jobs, that's certainly going to keep some people in a corporate environment versus going out on their own. So I'm sure there's some that's true, and there's I'm sure data and studies and so forth that support that. I'm not an expert in that, but that would seem logical to me. The reality is, though, entrepreneurship, I don't think has ever been more desirable or attractive or in vogue or than it is today. And it may be true that the starting of new companies have declined over COVID, but I think so many data points are going to be thrown off through COVID for so many reasons. But what we're focused on, and we think job creation comes most from, is not from the start of a brand new company with one guy in a garage who's going to try to start a business, and we all know the stats that the probability of that company growing and thriving and even being here in a few years is very low. The real job creators are those who have a product or a service that is in demand, that people want, and has already had a certain level of success, but then struggle to scale. There's lots of small businesses we can think of where the owner, operator, entrepreneur is really wonderful and great, but the whole business revolves around that person. They struggle to be able to scale. They struggle to be able to grow and really create a lot of jobs, and too much ends up being reliant on that one, superhero CEO who it feels that nobody else can do their job and can't delegate, right? And that's a big part of what we're focused on, is helping those companies with 5 or 10 or 20 employees grow and scale to 200 to 500 to 1,000. That kind of scaling of these innovative companies, especially certainly in the technology space, they're going to create new types of jobs through new opportunities that come from innovation. Those are the types of companies that I think are going to create the biggest sector of jobs, especially jobs where we can reskill people in careers and in industries today that are declining. And I think there's going to be a growth in jobs in construction and manufacturing in certain sectors, and as well, that you talk to anybody in construction or maintenance, so forth, they say there's not enough skilled or even moderately skilled workers in that sector. So there are certain industries that are benefiting from a lot of what is happening, and are creating opportunities for people to reskill and repurpose themselves. So we could talk a lot about this, and I encourage you, if you're interested, if this is a topic that's hot on anybody's mind, this jobs crisis and the challenge with unemployment and underemployment and the future of automation and how this is going to play out, to listen to the podcast we have. I brought on some really incredible economists and experts and heads of entrepreneurial, Drexel's School of Entrepreneurship and so forth, who have some really interesting perspectives and insights on on what we do to create jobs here in the United States today and tomorrow.
Excellent. Awesome. And I know we'll put that link into the chat box as well to subscribe for the Impact Podcast. That's great. One more question from Amar that's a little more specific about how we operate, and then I'll turn it back over to Rich to wrap us up with some questions about our new funds. But Amar asks, can you speak about how we avoid conflicts of interest since everything is in-house or vertically integrated? So how do we protect investors based on the way that we're structured in terms of our operations and how the different groups are compensated?
Well, I'd say first most critical point to that question is we protect investors by being vertically integrated, right? So that's the first point. Is the reason we're vertically integrated is to protect investors and maximize returns, right? Hopefully Melanie's not listening, or too many of my property management people aren't listening here, but property management's a tough business, right? It's not a sexy and attractive business. There's no money in property management, as an example, but we have 200 people working in property management because it's what protects our investments and maximizes our returns. Not that because it makes us a bunch of money. If I won't say it in a public setting like this, but if people would be shocked if they knew how little money we make at Dlp for managing, 30,000 residents, right? I'm not going to retire from anything else we do at Dlp over property management fees, right? I mean, it's not a business that drives profits for it, but we do it because we need to generate the best returns and protect our investors. So, and the second question I'll say is for at Dlp, we provide, number one, transparently in terms of what we charge, and that they're affiliate companies. We brand, and we're going to do an even better job of this. You'll be seeing soon of us kind of syncing up our branding even better, but we brand all our companies as Dlp. So we're not trying to hide that we do the property management or we do the lending or we do, any of the different services. That's obvious, and that's why people invest with us. But then also we provide the services we provide to our investors at market rates. So, we don't hide what we charge or that we're doing it or that we're affiliated. And if you spend any time with us, and if you, and even if you're not growing a company and you want to better understand how Dlp operates and why it's critical that we do the various business lines and are vertically integrated, I encourage you to read, Building an Elite Organization, understand how we grow our organization and how we operate and how we execute. And I think you'll even if you're not, somebody runs a business day, you'll understand that what we do is different than how most companies operate, and you understand why we get superior, results and mitigate risk. So.
Excellent. Thank you very much, Don. So a couple of quick questions before we wrap up here on the new funds. The first is from Tim on the Preferred Credit Fund. I'd like to know what's the expected maximum LTV ratio, including the first lien positions.
Yeah, great question, and I don't have an exact answer for you yet, Tim. So I don't want to say anything that's not going to be exactly correct yet. So that's why we, we're still working through and doing some overall modeling for the fund and finalizing those numbers. But what I'll say is, as I said a bit on that slide, we're expecting to have on average today, and this is not an exact number, but I'm just giving you a rough number. Somewhere around $80,000 of equity is invested in the Dlp Lending Fund behind every Dlp Lending Fund loan. That's the average. In this fund, we're expecting the average amount of equity invested behind our loan to be over $1 million, right? So significantly more skin in the game. The average borrower of the Dlp Lending Fund has a low 700 credit score, $3.5 million net worth, $500,000 liquidity. They've done more than 50 real estate deals, high quality real estate operators. The level, though, of the Dlp Preferred Credit Fund is going to be, significantly higher than that, with a, often 7-figure amount of equity invested behind our investment. So the exact LTV percentage, I'm not sure yet where we're going to end up exactly there. We're literally still in the process of finalizing those types of details up, but those are the critical points to how we're going to structure the fund and mitigate risk.
Excellent. And the final question from Pedro is just around the two funds combined. Anything that you can share in terms of initial capital raise sizes, and do we have a pipeline that we're growing to launch these?
Yeah, wonderful question. So both funds are going to be $500 million funds to start with, and there'll be evergreen open-ended funds that will grow over time. As many of you may know, our funds being evergreen, we don't go out and do a horse and pony show and go raise money for a period of time and then go deploy it. When those funds open on September 30th, they're going to be open, and meaning we'll start taking in subscriptions, the next day. To date, we've never been in a situation where we couldn't deploy capital. Sometimes it's taken a little longer than we like. Sometimes it's taken us in some of our funds as long as 60 or 90 days to fully do it. But we have a pretty strong pipeline on the development side for the Building Communities Fund that we are expecting. We're finalizing that up right now that we'll be able to seed the fund with deals that we already have under contract and already are working on. On the Preferred Credit Fund, one of the great things there is we're going to be able to serve a lot of the same borrowers we serve in the lending fund and be able to go get a different segment of their business and go after our very best real estate operators and do more business with us. We know the demand is there. That's why we're launching the fund. So very confident we'll have the demand and be able to deploy money quickly in those funds. And we're still finalizing though internally of what kind of internal targets we want to set to what we want to bring in the next, in the first 90 days. But what we want to do at DLP is, even though we're not a financial advisor, we're not a fiduciary per se, is we certainly want to make sure we provide you, and we'll be doing a lot of this on September 30th when we launch it, with the full understanding of what each of the funds do, what each one's strengths are, what each one's weaknesses are, so that we can talk to you through, based on what your goals are, help you decide which fund makes the best sense for you. So you guys as our investors are going to, is essentially we're going to have 5 investment funds available on September 30th, the Dlp Lending Fund, the Dlp Housing Fund, the Dlp Positive Note Fund, and the 2 new funds. So based on your goals, you'll be able to decide what allocation you want to make to which fund based on what helps you achieve the goals. And certainly we expect a lot of our investors to do what they've historically done, which is break up their allocations across, multiple of our funds that hit different goals, different return profiles, different tax benefits, et cetera.
Excellent. And before I turn it back to you for closing remarks, just a reminder, you mentioned September 30th, right? That's our big prosperity and elite events. We're also going to have our dinner that night. So that will be virtual, but we're going to have a live dinner here in St. Augustine. So would love investors and those interested to join us. And again, before then, even next week, we have a prosperity members only call. So if you're a prosperity member, you'll see that communication. We'll be meeting next Thursday. And those of you who want to become prosperity members, please reach out to all the folks that you work with today, Larry, myself, Bob, Brett, Mike. Love to get you signed up before the August 26th call. We will be talking about the bank as well after that prosperity members only call. So again, if you haven't signed an NDA and you're interested in that opportunity, reach out to us on that again. I'll just say it's wonderful, right? We do these events, but it's a monthly call that gives additional content to prosperity members only, where again, we're taking folks from just not only success, but to significance. So would love to help others out and have you join us. So with that, I'll turn it back over to you, Don.
Well, thank you, Rich. You did the job of wrapping it up for me, so I appreciate that very much. So yes, please come join us virtually or live. Hopefully you can join us live at our upcoming events. Reach out to the team if any questions on the new funds, but I gave, just to give a heads up, I know there'll be people with lots of specific questions. The information I did give tonight is pretty much the details we have to give today in terms of the big broad strokes on the funds and what they're doing, but certainly can give more color and context. But the full rollout of the exact fund returns and exact details, the exact preferred return, et cetera, will be on September 30th. So please stay tuned, be with us for that. And thank you for all of your support. All of you existing investors, all the prospective investors, I hope you got some value here tonight and that you'll be following up with us and exploring opportunities further. So thanks, everybody. Talk with many of you soon.
Have a blessed day all.
See you, everybody.